Welcome back, everybody. Now, if you're anything like me and you try to keep up with the financial news, you know that every single day we're inundated with conflicting financial information and opinions. And as investors, it's pretty confusing. And just yesterday, billionaire Paul Tudor Jones made headlines when he said this.
Would you want to own equities? I mean, there's also the question of what you think is going on in the United States with our economy, with the rest of the world, with what the Federal Reserve is or isn't going to do.
It's a really challenging time to want to be an equity investor in U.S. stocks right now. It's really hard.
Now, Paul Tudor Jones is best known for predicting the 1987 market crash, being a billionaire hedge fund manager, and being bullish on Bitcoin in 2020. But in his visit to CNBC yesterday, he brought up two major reasons why he thinks it's a challenging environment for U.S. stocks. And in this video, we're going to go through each one to see what, if anything, we can take from it and possibly do about it. So let's get started and take a listen to the two issues that he's concerned with.
Because again, you've got the geopolitical uncertainty, which we, I think, come to live with to a certain extent. But again, all those have the ability to have a nonlinear outcome. So something not just business as usual. But I think equally as much of a problem is the fiscal situation that we're facing in the United States, which is going to require a completely different political mentality.
And I want to break each one of these down because these are two issues that right now are really dominating the news and the headlines for us. So let's take a listen to Paul Tudor Jones as he explains the first one.
I think Israel, obviously it's a huge tragedy, but you have to put it in a larger geopolitical context, which is we now have possibly three theaters where we're going to have geopolitical challenges. We've got the Middle East and Israel, obviously the Ukraine and Russia, and then at some point down the road, Taiwan and China. So it's a really, I would say, certainly since I was born, it might be the most threatening and challenging geopolitical environment that I've ever seen. But
now, obviously, I'm no geopolitical expert by any stretch of the imagination, but I do think the point that he's bringing up is an interesting one because he's saying we've had this conflict that's been going on for quite a while in Ukraine. Now we have a second one starting and a third one possibly brewing in the background. So overall, the tension around the world in terms of potential conflict is just continuing to grow and compound. But I think the question here for us is, what can we actually do, or how should we be thinking about this? And Andrew Ross Sorkin asked that exact question.
To this existential risk that you talk about, these nuclear powers, is there any way as an investor to even think about that beyond just the end? Meaning, do you say to yourself, I need to, dare I say, hedge myself against these risks, or do you say that these risks are just what they are and so I have to keep going?
I think we've become inured to headline risk. If you think about the market's reaction to what happened over the weekend, it was a linear response, right? It was risk off, but it wasn't anything that possibly recognizes just how dangerous this could be. So, and I think that's because we've gotten exhausted with headline risk. It doesn't mean that we can't have a nonlinear reaction, the markets down the road, if something bad happens.
And I thought this was an interesting response because he's saying that the market response up to this point has been muted because we're all kind of exhausted, or how I would call desensitized to all the news that's going on in the world. And so his message is really to be cautious because all we've seen up to this point is a linear response, but that if anything escalates or additional bad things happen, it could actually turn into a nonlinear response. And what he means by linear and nonlinear response is that a linear response is what people would consider a normal market movement or reaction. So, stocks are down 2 to 3%, probably even up to 5% in a day would be considered a linear response. But then a nonlinear response would be a change that has a magnitude that is nonlinearly related to the cause or input. And sometimes people explain this concept when it comes to stock options versus normal stocks, because options come with leverage so that a slight change to the input can lead to a large change in the output. So all he's saying is that up to this point, nothing really out of the ordinary has happened, but that we shouldn't expect that the market is just done reacting to it, and that it may not even have started to react to it. And I actually think this is a really reasonable perspective. And when talking about that risk and possible nonlinear response, Paul Tudor Jones talks about his approach to stocks like this.
From a personal standpoint, would I be investing in risk assets now in stocks until I saw what the resolution was with Israel and Iran? You know Israel's going to respond in some way, shape, or form. The determination of whether Iran was actually responsible is enormous because, again, it has the possibility to really escalate into something terrible.
So basically, he's waiting for a resolution of this situation before he even considers getting back into stocks or risk assets, because he would prefer to just wait on the sidelines until the risk of that nonlinear response dies down. And now we're going to talk about this at the end, because like everything else as it relates to investing, context and nuance matter. But before we get to that, let's talk about the second big risk that Paul Tudor Jones sees.
So that is also happening at the same time the United States is probably in its weakest fiscal position since certainly World War II, with debt to GDP at 122%.
And this to me is where the conversation gets a little bit more interesting, because we definitely have the global conflicts as a risk, but it's happening at a time when the U.S. is in its worst fiscal situation that it's been in over 80 years when you look at debt to GDP. So let's listen to how Paul Tudor Jones breaks down the U.S.'s fiscal problems.
I would say the fiscal situation is very different from other cataclysmic events that we've suffered as a country. It's not Pearl Harbor, it's not 9/11, it's not COVID, where we did not see them coming. They were external shocks. The fiscal situation we have is one that's really clear, and there are obvious remedies for it, and it's something that we're going to have to deal with. It's not part of the political dialogue yet, really. I don't think so.
Entitlements again.
Well, it's a variety of things.
But mostly.
If you just think about what's happened since really in the last 3 or 4 months, we're getting ready. I don't know if we'll have a Minsky moment in the bond market. I don't know if we'll have that point of recognition, but we're going to have the grinding reality that with 122% of debt to GDP, as interest costs go up in the United States, you get in this vicious circle where higher interest rates cause higher funding costs, cause higher debt issuance, which cause further bond liquidation, which cause higher rates, which put us in an untenable fiscal position. Our interest bill is going to very shortly exceed our defense spending in just a couple of years. It's probably in 4 or 5 years, ceteris paribus, we'll have the highest interest bill as a percentage of GDP that we've ever had. It'll probably be close to 20% of your taxes will go to pay interest on the debt unless we do something.
And this is a point that I definitely agree with him on, because to me, our debt situation is completely out of control. And I don't pretend to be some macroeconomic expert as it relates to the U.S. economy, but I do know that when I see charts like this, that it's just not good. Like, there's nothing good that can come from a chart like this to me. And even with us being the main global power in the reserve currency, at least for now, at some point, this has to either get better and start trending the other direction, or it starts to cause something really bad to happen. I mean, right? It has to. And then lastly, one of the more interesting parts of the interview that I thought is hearing Paul Tudor Jones talk about what he sees in the bond market and how, regardless of what the Fed does with interest rates, it may not matter because the bond market itself might push us into recession.
Right now, here's what the bond market is telling you. Last year, or this year rather, we had $2.3 trillion of funding that the private sector is required to find the funding for. So that has caused a 100 basis point spike in bond yields. In 2024, it's going to be $2.7 trillion in the U.S., $2.7 trillion. Almost 10% of our budget is going to have to be to fund our federal spending.
So it doesn't matter what the Federal Reserve says at this point. They've lost control. This is going to be the bond market talking and setting rates.
The bond market. So what's happening is, and why we're probably going to go into recession sometime in the first quarter of next year, probably because the bond market, simply through supply and demand, is going to deliver more rate hikes because we don't have a clearing price yet for long-term debt. And so those rate hikes are probably going to tip us into recession.
So as much as we talk about the Fed and how the market hangs on every single word, it may not even matter that much what they end up doing with rates if the issues in the bond market persist the way that they have been. So overall, Paul Tudor Jones is clearly bearish U.S. stocks, and for those two major reasons. And in case you're wondering, later on in the interview, he did say that he can't love stocks, but he does like Bitcoin and gold. So do with that information what you wish. So all that's well and good, but what should we actually be doing about this? So my general thoughts are, I don't actually disagree with anything that Paul Tudor Jones is saying. The question that I have is, what tangible action items can long-term investors like you or me actually do about any of this? And at a high level, you would think that it means people should get out of risk assets like stocks and put money into something with a safe yield. And you see this information all over the internet, especially when you talk about dividend stocks, because people will say, oh, a 3.5% dividend yield is dumb when I can get 5% in treasuries. You loser. Okay, so I may have added that last part, but that's actually how I read it whenever I see those comments. And look, there's definitely some truth to that. You can move your money out of stocks and into a safer yield-bearing investment as long as you're willing to live with the following effects. 1, a possible tax hit on any investments you have in taxable accounts. 2, possible interest rate risk of moving into yield-bearing investments that may or may not outperform the market. And then 3, which is related to the return risk of potentially being out of the market during any good days or the start of the recovery. And if these are things that you're absolutely comfortable with and you have the knowledge and experience to handle it, then go for it. That makes perfect sense. I think for most people, though, the possible risks are worse than just staying invested into foundational ETFs and quality stocks and not trying to predict what's going to happen next. And I know you've all seen those charts that basically tell you, oh, here's your return if you miss the 10 best market days or whatever. And just to be clear, I don't love these type of charts because I think they're shared a lot of times without a lot of context, like there's only one right way to invest, which I just don't agree with. But I do think it has value to show one specific thing. If you're a person who doesn't feel like you have the skills or knowledge to time the market and you don't want to take on that risk, then staying invested will more likely give you a better return over time than trying to tinker with your portfolio just because of what somebody said on a CNBC interview. Because remember, even if you get the timing right, you still need to make more on the trade than you lost in any taxes that you had to incur. Otherwise, there's no point in doing it. So as for me, you guys probably don't have to think too hard to know what I'm going to be doing. I'm going to continue doing my due diligence to try to find great companies that I can hold long term, try to add them to my portfolio when they're trading at attractive prices. Boring, consistent. And just to hammer that point home, here's a great excerpt from Peter Lynch, who's one of my absolute favorites.
If you own stocks, there's always something to worry about. You can't get away from it. What happens in the 50s, people were worried about the only reason we got out of the Depression was World War II. We got another recession in the early 50s. They said we're going to go right back into a depression. People worried about a depression in the 50s, and they worried about nuclear war. But in the 50s, people wouldn't buy stocks, except for the 80s. The 50s was the best decade, this century of the stock market. And people wouldn't buy stocks in the 50s because they're worried about nuclear war and they're worried about depression. Then people, remember when oil went from 4 to 40 and it was going to go to 100 and we're going to have a depression? Remember that one? Well, about 3 years later, the same experts, now higher paid, oil's now at 10, and they said it was going to go to 4, and we're going to have a depression. So there's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve. I mean, whoever cared what was under the damn curve? I mean, you know, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is. And I'm ready for questions.
Now, ultimately, I have no idea what's going to happen in the market or if the concerns that Paul Tudor Jones has are actually going to come to fruition. But I do know that my mentality and my temperament happens to match up with the approach that Peter Lynch talked about, so that's definitely what I'm sticking with. So what do you guys think about it? Are you concerned with the stuff that Paul Tudor Jones brought up? Let me know down in the comments below. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.